I think it's safe to say that REITs have not been a favorite sector among investors during this rate hike cycle that we have embarked on with the Federal Reserve over the past year plus. As you can see here, the broader REIT sector has badly lagged the S&P 500 the past 12 months, with the S&P 500 down 8% compared to the Vanguard Real Estate ETF VNQ down nearly 25%. When it comes to REITs, they come in all shapes and sizes. They are a very diverse sector. But for me personally, instead of investing in REIT ETFs, I like to build my own ETFs of the highest quality and best REITs on the market. This way I get a solid portfolio of just the top performing REITs and no fees. Now that this rate hike cycle is nearing its end, will REITs return to their rightful spot on top as one of the best performing asset classes out there? Well, not so fast. Remember, even though investors want to cheer a rate cut typically coincides with a weaker economy. However, there are companies out there and even landlords, which are REITs, that have high quality tenants that could perform well and are a little bit more immune to a recession or an economic slowdown. And in today's video, we are going to look at two REITs that have been punished badly and are down 20% or more, but they look worthy of a buy at these levels. If you love REITs like I do, make sure you do me a huge favor and click that like button down below, as I truly appreciate it and it helps the growth of this channel moving forward. With that being said, let's get rolling. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please perform your due diligence before investing in any stock mentioned in today's video. Also, before we get started, let me take a quick moment to thank today's sponsor, The Motley Fool. The Motley Fool has a ton of great products and tools available for investors of all levels. And right now, if you go to fool.com/Mark, you could sign up to receive their best 10 stocks to buy right now, and you can do that completely free. Now let's get back to the video. REITs, REITs, and more REITs. These are two REITs that are down 20% or more over the past 12 months. And the first REIT we're going to look at is Alexandria Real Estate, stock ticker ARE. Alexandria Real Estate has a market cap of $21 billion, and they have been a REIT that has been trading on the market for 25 years. Alexandria is labeled an office REIT, but really they are a life sciences REIT, housing some of the most advanced science in the world. They lease out to tenants that will continue to conduct research regardless of the economic backdrop. However, over the past 12 months, as you can see here, the stock has been crushed, down nearly 40%, badly underperforming the REIT sector and the S&P 500. At the start of 2022, shares of ARE were trading around $225. Today, they're at $120, a level last seen back in 2018. Now that is quite a fall. Back in 2018, the company had AFFO, or adjusted funds from operation, of $5.27 per share. In 2023 though, the company is expected to generate AFFO of $7.35 per share. Same share price, nearly 40% higher AFFO per share. So what do we have here? We have a stock price that is trading at the same levels it was back in 2018. However, they're expected to generate 40% higher AFFO per share. Do investors think that growth is slowing or has completely slowed down? Well, AFFO in 2022 was 17% higher than the prior year. AFFO growth in 2023 is expected to be 11% higher in the year. So 11% AFFO growth this year would be the third best year for the company. Being a high-risk stock doesn't seem to be the issue, as the company has a BBB+ credit rating with a very solid balance sheet. They have $5.3 billion in liquidity. 99.4% of their debt is fixed with a weighted average interest rate of just 3.5%. They have a debt to adjusted EBITDA ratio of 5.1 times. So that potentially leads back to them being labeled an office REIT. And plain and simple, office REITs suck. However, Alexandria Real Estate isn't your typical office REIT. More employers have gone to this hybrid type of work environment, where you work a few days at home and you work a few days in the office. This has allowed employers to shrink the amount of office space they had. But remember, this is a biotech REIT with research taking place on their campuses and offices every single week. This isn't the type of research that you can do at your kitchen counter on 2 days or 3 days a week. Typical office REITs are getting hammered, not only their stock price, but also their results. But when you look at Alexandria Real Estate, they have been steadfast and near record leasing volumes, all while increasing rents. On a cash basis, the company saw rental increases of 22.1%, slightly below the 22.6% increase they saw in 2021. That is some huge rent hikes the past 2 years. Those rent hikes have led to an ever-increasing dividend. The company currently pays a dividend of $4.84 per share, and they have an AFFO payout ratio of just 65%. The dividend yield is currently at 3.9%, and the company has a 5-year dividend growth rate of 6.5%. Plain and simple, the fundamentals look appealing for this company, and the low multiple does not seem justified. Let's take a look at that low multiple. As stated, analysts are expecting a FFO of $7.35 in 2023, which equates to an AFFO multiple of 16.7 times. This is a REIT that tends to trade at a premium, not only in its sector, but in the REIT world as a whole. But now it's trading below the index, which just seems like a huge opportunity. For comparable purposes, ARE has a 5-year AFFO multiple average of 27 times. And if we expand that over the past decade, the multiple average is closer to 25 times. During the March 2020 pandemic lows, shares of ARE traded at 21 times. So right there, that tells you just how cheap shares of Alexandria are currently right now. The second REIT on our list today is Spirit Realty Capital, stock ticker SRC. Spirit Realty has a market cap of $5 billion. They are a net lease retail REIT, built very similar to its popular rival, Realty Income. The stock is down 20% over the past 12 months, and the movement has been swift. Shares were down nearly 30% during the October lows. Spirit does not get the type of hype Realty Income gets, one reason being they are much smaller in scale. Let's take a peek at their portfolio. As of Q4 2022, the company had 2,115 properties. They have those leased out to 351 tenants within 49 states. The company has a very near perfect occupancy rate at 99.9%. Spirit Realty has annualized rent of $681 million with a weighted average lease term of 10.4 years. Now let's take a more in-depth look at the portfolio. Looking here, you can see the company's top 20 tenants, which include companies like Lifetime Fitness, BJ's Wholesale Club, Dollar Tree, Home Depot, Circle K, Walgreens, CVS, and Dollar General, just to name a few. Many of these names are found on Realty Income's top tenant list as well. The top 20 tenants make up nearly 35% of the company's annual base rent. 42.1% of the tenants are service retail, followed by 23% industrial. Here's a look at the industry breakdown. We can see that 11.2% is related to distribution, 9.1% manufacturing, 7.8% health and fitness, and 5.5% are convenience stores. Overall, very well diversified in terms of sectors, but there are some areas of concern. How health and fitness will hold up if we fall into something more than a mild recession could be problematic. Manufacturing, depending on what type of tenants or what manufacturing is going on, could be problematic in a recession, and we already know about office. However, the percentages are quite low, and the thing with health and fitness you can see here is that more than half of that exposure is to Lifetime Fitness, which is a high-end, very well-run fitness club, and those members are usually higher income earners, which gives some sort of safety. While nothing removes risk completely, the fact that 64% of the company's tenants are businesses with over $1 billion in revenues does also provide some sort of safeguard. In terms of the dividend, Spirit Realty is much different than that of Alexandria, which we just looked at a second ago. Alexandria has a lower yield, but they have been growing their dividend at a 6% clip. SRC, on the other hand, pays a higher yield of nearly 7%, but the growth has been stagnant as best. So if you are not looking for high yield, SRC may not be the stock for you. But if you are, let's keep taking a closer look. Analysts are looking for 2023 to be very similar to that of 2022. Not much in terms of growth this year, but some growth is better than none as they're looking for 0 to 2% AFFO growth this year at an estimate of $3.57 AFFO per share. That puts the multiple at just 10.8 times. Over the past 5 years, for comparable purposes, shares of SRC have traded at an average closer to 13.1 times. In terms of analyst expectations, they have an average 12-month price target of $44 on the stock, implying upside of 13% just in the share price alone. Plus, if you add in a near 7% dividend, you're looking at around a potential return of 20%. Both of these REITs have been hammered over the past 12 months, and both REITs are very different. We have Alexandria that is getting more punished due to its label of being an office REIT, but as we saw, they are nothing like a typical office REIT. And then you have Spirit Realty Capital. They're getting punished more because of their exposure to retail, and we are headed for a potential recession. And this has created opportunities in both of these high quality REITs. Both REITs down 20% plus, both REITs having stable dividends, and both REITs trading at great valuations. Down in the comments section below, let me know which of these REITs, if you had to buy one, which of these REITs do you prefer? Is it SRC or ARE? With that being said, if you haven't done so yet, please smash that like button as I truly appreciate it, and we'll see you in the next video. Take care.